Hi there subscribers and welcome back to the channel. Today we're doing one of our invitations to our IFAs and Andiri has joined us all the way from Milton Keynes. Good morning Andiri, how are you?
Good morning, though. Very good, thank you.
Good. Okay, so the topic of the conversation today is how do financial advisors add value to clients? So Andiri, my first question to you is, could you briefly explain what you think are some of the misconceptions people have about the role of a financial advisor?
Yes, absolutely. And we're seeing this more in today's days, right? Area where you have robo-advisors, you have self-investors, and then you have the advisor, right? So people think that they can self-manage their portfolios, they don't see the need of a financial advisor because obviously it's cheaper. And that is true, right? I mean, if you self-manage, you're gonna avoid the cost of financial advisor. So and also consider that over the last maybe 10 years, we have seen most probably a bull market. So equities, especially in the US, were raising. So, self-investors that they just throw their money into I don't know, an index, a US index, or even the world index, they've seen the equities growing, right? The portfolio growing. So they don't feel the need of a financial advisor at the end of the day. And then there is a lot of information, on channels, on YouTube and the internet about how to invest. And then also we have the robo advisors, right? So anyone, like any automatic machine, can do a risk profile of yourself, and then they can recommend you a model portfolio, and that's it. But there is more to it, that all works very well when the markets are bulling, right? When we see like an upward trend in the markets, but when it's a drawdown, I mean, what we've seen, for instance, I think 2 weeks ago, when all the carry trades, transactions, in Japan were unwinding, and the market suddenly have a huge drawdown, then is when you need a financial advisors, because then there you see panic in the markets, you see a huge volatility, things are falling. And if you keep on watching your portfolio on a daily basis and you see your pension pot like drawing, right? People tend to react to that in a very emotional and most of the times negative way, and they start selling as well, and this is why the markets drop, right? The markets drop. So there is when you really need someone at your side, like taking that pressure off your shoulders and basically not looking at the portfolio on daily basis, if you are doing that, right? Because we do that for you. And then we are going to avoid a lot of wrong decisions, we are going to that you don't need to take, basically. And this is just in terms of portfolio management. But I'm sure that later we will discuss also where we add value in other areas, like tax guidance, estate planning, protection, insurance, and so on. So yeah, definitely, an advisors add value.
Yeah, very good question. That actually brings us to the next point regarding volatile markets. So my question was, how do you try to guide clients through volatile markets to avoid poor investment decisions?
Yeah, well, so firstly, we do this even we'll try to prevent that, right? With portfolios that are globally diversified and that they have a very good mix between fixed income, sovereign debt or very investment grade, fixed income, bonds, debt, and equities. Because remember that we think markets are equities, but no, you also have the bond market, and people, most of self-investors, and this is why as well you need an advisor, they don't understand bond markets. They are one of the most difficult markets to understand, even for us, even for me. I'm a CFA. Fixed income was one of the most difficult topics, in through all the examinations. So by having a portfolio that is very, very good, diversified, effectively diversified, and have some, allocation to fixed income, when there is a drawdown, this fixed income, is acting as a buffer, right? So your portfolio is not going to draw as much as what the index is drawing. This is the first thing. Then second of all is like, by having the advisor, we don't want you to check your portfolio on a daily basis. This is what you need to avoid. We are here for the long run, and that is what the advisor is doing. The markets are dropping. you just do nothing. And doing nothing is taking a position. I mean, doing nothing doesn't mean that you're not doing anything. You are doing something, which is taking a position that this is gonna, is gonna pass away. This is just short-term volatility that happens. And at the end of the day, what we try to educate our clients is like, look, we are here for the long run, and we are gonna give you on average this. We are trying to get you these returns on average, over a period of time. We are not here, for tactical moves or trying to chase returns of the hottest, funds in the market. So this is, I mean, sometimes boring. It's good, and this is a very boring or non-sexy approach of just putting your money in a very well diversified portfolio that has the good mix between geographies and equity and debt, and then living there. Don't touch it. Don't even look at it, and be there for the long run.
Yeah, very true. And can you share me an example of where, you're talking about clients going through scary patches, volatility in the market. Can you share me an example of perhaps where your advice has prevented a client from incurring a financial loss?
Yeah, it's when we see the drawdowns, right? When we see short-term volatility and markets, there are some unexpected news, some sort of war, or for particular funds, when there is a high allocation to one company, and that company has also unexpected news, you see the drawdown, right? And they want to sell. It's like people, they don't want to be in a sinking ship, and also they think that this is going to be, and this is behavioral finance. People try to think that what is happening now is going to continue, and they don't see that this is just momentary, right? So obviously, yeah, just preventing these sell-offs, when the markets are falling. This is how you are saving money, and incurring posting losses for the clients. But also at the same time, sometimes the fund is just not right. The fund has been posting losses for 5 years, and you see, clients that are coming from other, portfolio managers or whatever that they've been in funds for 5-10 years that have been, underperforming. Also, then clients don't want to sell to realize the loss, right? And then is when we said, okay, look, let us take over. We are selling now. We are realize the loss now, but there is the cost of opportunity, because if we realize now the loss, even if it is a small one, but then we are gonna put you in a portfolio that is good, that is globally diversified, that is constructed in a very professional way, then it's gonna grow. So it's both ways. Sometimes clients sells too early. Some other times clients, they don't want to sell, and both are wrong.
Yeah, and I think this is something common which we have with here at Cameron James. We fortunately or unfortunately take over a lot of existing clients in the industry, particularly in the offshore market. Clients who have QROPs, offshore bonds, maybe the financial advisor hasn't spoken to them in years and years. I know yourself, Andira, you've sent me some very, how can I say, difficult and complicated cases that you're working on. What is your general experience when dealing with these people? And, when you see such large losses on some of their portfolio, and again, to differentiate, guys, what Andira is saying is, yes, you can have losses in the market, systemic risk, but when something is unsystemic and it's just an individual fund which is not performing well, that's the point in time that you need to go in and change it. Andrea, how do you get through to these people, and how do you communicate with them when, say, they've been looking at their offshore bond and their QROP for 6 years, it's been doing badly, they come and meet you, and after 2 meetings, you're telling them, yeah, that fund that's 40% down, you need to sell it. How do they react to you, and how do you, I hope the majority of them, get them over that hurdle to do what is correct for their financial planning?
Mm-hmm. Well, it's a lot. So we go back to the fact how advisors add value to investors, right? Is by coaching them and by explaining, okay, look, this is the cost of opportunity, because S&P 500 has doubled in the last 5 years. I mean, I'm not saying that you should have been 100% to the index, right? But what you're having here is completely just the opposite, scenario. So by just talking to them, explaining to them, and making things, I mean, this is very complicated stuff. if you think about it, because you have so many participants in the markets that are not efficient. Sorry to say that, but it's not efficient. Though the financial theory try to make markets efficient, it's not, right? So it's by coaching them and by telling them, look, I mean, there is a huge cost of opportunity. You need to get out of here. We need to sell the full portfolio. Just start, from a clean page, and then move on and just forget about the past and look at the future. And most of the times, when you explain this in such a very complicated information, the advisor is a good advisor when he's able to convey this so difficult information in a very simple manner to the client so that they can understand them. And when they understand, then they trust you. And this is the relationship that is built on trust and properly formulating and translating all this very, very complicated information is when they trust you, and then you take over, then you sell the portfolio. 4 months later, it's already posting gains, and realized gains, but it's already, growing, and then they're happy. So yeah, it takes some faith, on the advisor. They need to give you control, and that's something that people, it's their assets, right? So it's all they have. But this is the job that we do, right? Conveying and translating all this difficult financial information in a way that makes clients trust us, and then we have like good outcomes, better outcomes for the clients.
Yeah, understood. I think it's a really important point. And there's a lot of clients, unfortunately, out of all the clients that do come through saying, oh, I've got an existing offshore bond, QNOPs, whatever it is, it's poorly performing. Unfortunately, not all of them do move ahead with advice. Off the top of my head, I can think of a couple of clients that you've been working with the past couple of years where they've just dug their heels in. Even some of them are pretty not high end, but investment professionals. They know their performance has been shocking, but maybe they have things like exit penalties. And this is where I think so many retail clients don't understand that financial planning is not just about finance and investments. It's about behavior. It's about our emotions. And I think what Andrea is actually making reference to here is the Vanguard advisor framework matrix they have, which basically shows a pie chart, which shows, and I believe it's around 1.5% is what the Vanguard study showed. That is the pure value that financial advisors or good financial advisors provide every single year for behavioral economics and stopping people from making irrational emotional decisions. So, for example, here at Cameron James, our ongoing annual management cost of 1%. The Vanguard study showed 1.5% is achieved straight away through behavioral economics, not even out of the other bits and pieces as well. So yeah, it's a very fascinating area. So Andrea, when it comes to things such as portfolio rebalancing, what are the potential risks that you see of neglecting correct portfolio rebalancing?
Mm-hmm. Yeah, and rebalancing is also something that self-investors, they don't do most of the times, but it's something so needed. It's maintenance, because we have, as I said, so we at Cameron James, so we work on the portfolios. We have a very good investment strategy, and the portfolios, the allocations to every fund, they have a rationale, right, for those allocations. But now when you buy, right, and then the portfolio comes live, those allocations, they change over time. Typically equities go up, right? And fixed incomes, allocation is getting smaller and smaller. So once a year, we rebalance the portfolios, meaning that we bring them back to the original allocation. And this is something, it's a job. It's quite of a job to do. Now, at Cameron James, we do this, we try to do this automatically. So there are automatic jobs that run, behind the scenes. And then we sell and we buy. And then we start every year, with a fresh portfolio, again, with the right balances according to the risk profile. And look, and this is also, when I'm saying according to the risk profile, this is regulation. Clients need to be in a portfolio according to the risks. If you do the rebalancing, you are not complying with regulation, because you're going to have investors maybe after 10 years, if the advisor is not rebalancing, or if they are self-investors, the allocation to equity is not going to be according to the risk profile, right? So, I mean, simple things like that, they have a big impact, and yeah, I mean, so you want to try to avoid not to rebalance. You need to rebalance at least once a year, and we do this automatically, at Cameron James. So yeah, so this is another area where we add value, definitely.
Yeah, and I think it's really interesting because a lot of clients, when they hear the word rebalancing, I think a lot of clients think of that in terms of like tactical rebalancing, which is obviously an entirely separate thing. What Andrea is talking about here is if you start a portfolio with 65% equity weighted over the course of 5 or 10 years, if that portfolio, say, grows by 50%, the equity portion of that portfolio would have grown far more. So the 65% equity might be 75% equity in 10 years' time or 5 years' time, whatever it might be. Now, for a lot of clients, that might be good because in my experience, the majority of clients do not hold a level of equity weighting which is actually in line with their capacity for risk and loss. So this brings me on to another bonus question I just made off my head, Andiri. I often struggle with, less so now, but when I started out towards the beginning of my career, probably because I have more experience now and clients want to listen more, but I used to struggle that clients had this concept that, okay, I've become 65, now, my portfolio needs to change. I need to de-risk. I need to do this. And I need to be more conservative now because I've become retired. I've always struggled with that concept because at the end of the day, they're probably going to live until their 80s. They may even want to pass the capital on to their beneficiaries. Why is it that you think so many clients, and again, is it behavioral? Is it instinctual, subconscious? It's been nailed into us. Why is it that so many clients want to try to revert to something more cautious when they perhaps have decades and decades left to be invested? What are your thoughts on that?
No, and well, first, and again, this is not so simple. I mean, people try to simplify things because they want to do things themselves, or because they don't have like a great advisor that is just picking up some, the simple, rules of thumbs, whatever. I mean, this risk profiling someone, I mean, there are two things to it. One is your attitude to risk, and then is your capacity and your tolerance to risk. You can be very, very young, right? And then we will say, oh, wow, you will be more adventurous. But if you need to withdraw tomorrow, then your capacity for risk is zero, you see. Whereas you can be 81, but if what you're trying, if your wish is to leave your pension pot to your children that are maybe 50 or 40, then your risk tolerance is very, very high. So this is, again, something why you need to have someone, an advisor, looking at you, looking at your priorities, looking at your goals, and and combining this attitude to risk and your capacity to risk together, because it's not so straightforward. And then, yes, I mean, as I said in the beginning, finance is complicated, it's very difficult, but as an advisor, then we need to be able to translate all that information and bring it to the clients in a very simple way. Like, for example, obviously you don't want risk. You are 81, you're very, you obviously you are not like so young anymore, but this is for your children, so we are going to increase the risk exposure, right? And we are going to increase the equity level of your portfolio. So it's down to, we cannot say, we cannot use general terms like from 65 you need to increase your fixed income exposure. That's not correct. And also, fixed income has also risks, and this is why people don't understand. I mean, all these self-investors, fixed income, I think sometimes it's even more riskier than equities, just for the fact that people don't understand it, right? I mean, those, again, talk to a financial advisor. Don't try to self construct portfolios yourself, because it's not so easy. We try to make it easier for our clients to convey it in a way that they can understand, so they can trust the advisor. But it's rather difficult.
Yeah, and it's interesting. I saw a wry smile on your face because I know when you said 81, it wasn't random. I know the specific client you're talking about was actually a gentleman who came through. He had you'll correct me, is your client a QROPS based, is it Guernsey or Jersey, the QROPS?
In Guernsey. Mm-hmm.
In Guernsey, yeah. And his net worth is sort of north of 30, 40 million. This circa 2.3 million pot, because of his age, most people would expect, but the client saying to Andiri, look, I'm a pretty smart person. I've made a lot of money over my time. This pension pot, I don't want to take the income from it. So I don't want to have to take drawdown, but also I want this pension pot to be invested with a good high risk profile because I have a high tolerance to risk. So this is obviously, that's a bit of an extreme example. Not a lot of clients come through with 40 million net worth, but that's just a classic example of how, not everyone fits into one straight line. So the next question for you, Andiri, is, could you share any examples of how your advice has led to better financial outcomes for clients with their portfolios?
Well, yeah, I mean, as we said, just the pure construction, right, of the portfolio and the investment strategy that we take at Cameron James, right? This is that like the first step, the first building block, right? And so the investment strategy is very simple, right? We don't believe in active management. We believe, or we wish to give the clients the return of the world, what they will get, if they will invest in the world. And then we build the portfolios trying to track that index through passive, through ETFs. And then we have the mixture of fixed income and equities. So it turns out to be a very cheap and globally diversified portfolio. So it's very difficult to do any changes to the portfolio. And this goes back to when you were talking about rebalancing. So rebalancing is an automatic cleaning exercise, maintenance exercise. Rebalancing just for the sake of churning the portfolios, we don't do it at Cameron James. So every time, and you know that sometimes I try to push, changes in the portfolios, just, some tacticals, new funds, whatever. It's very difficult. They get rejected. So it's just all this work we do in advance, when we're constructing the portfolios. This is how we're actively, through passive, we are actively adding, a value to the clients, right? And then once the client is invested, the way we add value, is by not touching the funds, the portfolio. We try to, as I said, we only rebalance once a year. Then the rest we are on the long run. This is very boring. It's not sexy. I cannot tell you we are doing active, weird things. We are trying to track and change and whatever. No, it's boring. But in finance, boring is good, So we are there for the long run. No sexy strategies. Just keep it quiet, keep it there. Don't touch it. It's only when, and this is the key, it's only when the clients are in withdrawal, when they start drawing down income, then there is very important that you have an advisor, because we need like a strategy, for withdrawals, right? Because we don't want, like, if you tell me tomorrow, okay, or imagine when the markets were in drawing down, right? Because of Japan. If I have a client that same day tells me, okay, Andrea, I need now 100,000 pounds, then we're in a problem, right? Because we're going to need to sell when the markets are plummeting. So with my clients, and we do biannual reviews, then always one of the questions and one of the topics we discuss is, what are your liquidity needs? This is key. And this is something that if you don't have an advisor, you don't even think about it, right? So we need at least 6 months, 3 months in advance. We ask the clients, okay, do you have any liquidity needs? Because then I need to know as your advisor, because you are giving me maybe 4 months to check the markets, to see when I'm going to place the sell order. Once we sell the funds for the liquidity you need, we place those funds in a money market account, that is not going to have, that is risk almost zero, right? You're going to earn like some return, but you're not going to be exposed to any volatility. And then we make sure, basically, that when you need the money, you're not going to face a big drawdown in the portfolio. And that's the way we are doing it. Because at the end of the day, the best situation will be that the clients that are in drawdown, that they can get this income, this by the return that the portfolio is producing. Imagine if you need an income of 5% and the portfolio is producing year on year 5%, then you are living on that return. and you are not eroding the capital. I mean, and this is something, I mean, it's very, very important, this discussion that we have on a regular basis with the clients. Okay, what are your liquidity needs? What is your income needs? And what is your expectation in terms of returns? That because this also gives me a target, right? Okay, this is my target return. I need to get this for this client, so I'm not eroding the capital. And then I know exactly, well, or at least I can figure out a plan when to withdraw and when to sell.
Yeah, answered. Really fascinating, Andiri. Thank you for joining this morning. As a final point, Andiri, anybody who's watching here saying, oh, I've managed my portfolio myself for, I don't know, 5, 10, 50, 20 years, whatever it is, what would be your advice to someone, or maybe someone looking to transfer a pension now, they can't decide whether to use a financial advisor or not. What would be your advice to someone in that situation?
It's like there is a lot of information, right? But you need to be careful because it's not easy. Finance is a matter of probabilities. So if you tell me that you understand probability and that you can figure out what is going to happen in the markets in the next 1 year, okay, I'm not going to buy it because it's probability, right? So it's going to be always a matter of on average, this and the other. So just be careful because it takes a lot of time. I mean, the CFA is 3 years of a study while you are working. The exams are 6 hours long, each exam, so it's not that easy. And as I said, in a bull market, and this is what has been going on, and the self-investors, if you think about it, I mean, all these self-investors, they've been growing over the past 10 years. Yeah, we have like an asset a bubble, you know, because the interest rates were so low. Of course, these guys is like, yeah, now I understand the markets because I made so much money just, you know, dropping all into an index, you know, and it's been growing like crazy. But this is not, I mean, this is just a period in time. And a regime, we call it a monetary regime, you know, and this is what they don't know as well. This is going on is because behind you have a very a specific monetary policy by the central banks in the world. You know, this is why the portfolios were growing so much. The assets were overvalued, but this can change, you know. So always think that this is complicated and that they're just trying to simplify things. Yeah, the advisor make it simple for you, but by looking at all the data. I mean, just cherry picking this and that and the other and trying to build your own portfolio, it's a bit risky, I would say.
Indeed. All right. Well, thank you very much, Andiri. Always a pleasure. I look forward to having you back on the channel soon. Anyone, if you'd like to reach out to Andiri directly, my team will put her email address at the bottom here for you to contact her. All the information we talked about today is in the description section below. And Andiri, I look forward to having you on the channel again very soon.
All right. Thank you, Dan. Thanks for the opportunity.
Thanks, guys. Bye-bye.